Well, the Fed just had their latest meeting and released some information, obviously very key to what we watch in terms of mortgage rates. So we'll get the latest update from Bill, get his reaction to the latest news, what the Fed said, and what it could all mean coming up for the month of February. That's next. Welcome into the Smart Mortgage Show. I'm Ben George alongside Bill Litton at Cross Country Mortgage there in Chadds Ford, Pennsylvania. Bill, finish up the month of January, moving into February, and of course, we're recording this literally right as the news is coming out on the latest Fed meeting. So I guess kind of sum it up for us on what you saw, the latest information you have, and whether you're viewing it as a positive or negative or just kind of maintaining course moving forward.
Yeah, Ben, it's interesting because I feel like in a few senses it was positive because so the Fed, they just wrapped up their 2-day meeting and they released their minutes at 2 p.m. Eastern. And in those minutes, they basically said that, the U.S. economy, even though the Federal Reserve has dramatically increased interest rates, okay, and there's several other tightening measures that they've taken, the U.S. economy is still chugging along very strong,
okay,
probably stronger than the rest of the world. And that's a little bit of a surprise because we expected that, the economy would slow down, but we're getting strong GDP numbers and all of the other indicators are in line saying that our economy is still strong. So that's a great thing. As far as interest rates are concerned, 30-year fixed rate mortgages in particular, because that's the most popular mortgage instrument that people use, that I would say probably doesn't cause us to go back into the 8% range of interest rates, but it does slow the decrease of interest rates in 2024. So inflation is coming down, but it's still elevated and the economy is still running strong. So a weaker economy would mean the Federal Reserve lowers the rate to accommodate the weakness. But we're not seeing the weakness, and we're not seeing unemployment. Now there's been some, UPS and Citibank and other companies are scheduling a lot of layoffs in the next quarter, but overall the job market is still strong. So where this takes us, probably not a dramatic, like when you said staying course, I feel like for the most part, it keeps us on course with maybe a slight delay on the decreases we're hoping for this year.
So it's kind of a weird position to be in, right, in your industry, because you're watching this and not that you're hoping for weak growth in the economy and the jobs report to be bad news, but it's good for the people that you work with to see that those tides shift a little bit, right? So it's not that you're pulling for it, but when you see that, hey, the economy is slowing down, this is good news for people that are trying to get into a home, right?
Yeah, it's so people that are trying to get into a home and the interest rate and the payment is the barrier. This news doesn't help their case, but it's also hard to be against this kind of news because it's telling us that our economy is doing well. And all of this, and our Federal Reserve, they get a lot of slack and a lot of people don't appreciate the job they do, but it's a unique committee and the way that it's set up, that it's not tied to any political party and that they try and ride this balance of enough support to keep the economy going and pulling back when it's too strong and trying to keep everything in equilibrium. It's kind of fascinating, actually. And so their job now is to, continue to slow things down a bit. The only way to do that is with rates to remain where they are for a little bit longer.
Okay. So when rates remain where they are, and I've got CNBC on in the background, and I see the big red bold headline, Fed leaves rates unchanged. Does that mean that mortgage rates will be the same? Will they remain unchanged, or is there a possibility that they could creep up a little bit from where they started the year?
That's a great question. So the Fed left the federal funds rate unchanged, which is not directly correlated. It's correlated, but it's not a directly element of change for a 30-year fixed rate mortgage. But since they left it the same, we're thinking that the 30-year rate should probably stay where it is for a little while longer, which is just at about 6.5%.
And 6.5% still pretty good position compared to where we've been over the last 12 months or so. So as we kind of look, I know we're getting close to, we're still in the middle of winter here, Bill, and I know you feel it probably there in Pennsylvania and surrounding areas. We've had a lot of cold weather so far, but I know kind of looking ahead, it won't be long. Our next kind of market update will be in the beginning of March, and we'll be talking a little bit more about spring. So what have you seen in terms of inventory and how that's moved at all here beginning of 2024, and kind of where do you think we might head over the next 29 days of the being a leap year?
So right now, at least in this southeastern Pennsylvania area, northern Delaware, the inventory is still quite low, and there are still bidding wars, and you still see a lot of frustration with buyers who are trying to get under contract in multiple offer situations. And I've heard a lot of my realtor friends are saying, I've got 5 listings coming on in the spring market, or so there's an optimism there, and it seems that there's going to be a lot more inventory. I think the people that did nothing last year but really wanted to move are willing to take a higher rate if they need a mortgage on their next home. So it's kind of like, we call it the golden handcuffs, right? A large percentage of people report that they're not super happy with the purchase that they made during COVID because there might have been no inspections. In some cases, they never even saw the house. It was a virtual showing, or the showings they had, they were limited to 10 minutes, which is, think about that. I spend more time, buying a car for sure. Sometimes more time buying a loaf of bread.
Yeah.
Right. So I think that with those folks who they're tied, the golden handcuff is that 2.5% rate. They're handcuffed to a house they really don't want to be in. I think some of those people are rethinking their position. And last year, all we talked about were rates being high and didn't know when they were coming down. And this year we're seeing inflation's down dramatically. We're hearing that, all of the Freddie Mac surveys, Fannie Mae surveys, other industry and trade group surveys are saying we think rates are definitely going to continue to come down. So if you move and you're in the 6.5% rate upon settlement, there's a really good chance within a year you're going to be in the 5s because you're going to refinance, and possibly lower than that going into 2025.
Yeah, I'll kind of close it out with the latest kind of news that I've seen. Is I'll peruse a lot of the mortgage news just to kind of stay updated, right, in terms of the stuff that's curious to me, to ask you some questions here on the show. And I know other people might kind of wonder about as well, but I've just seen that some of the mortgage demand has dropped a little bit because, as you mentioned, the inventory is still low. Is that just because there's not enough inventory out there for people to look for mortgages? They're just kind of holding put right now? Is that basically how the inventory impacts the mortgage and how many people are coming in to see you guys across country?
Yeah. So if less people are buying and less people need mortgages to buy those homes, that absolutely affects the amount of customers that we're able to interact with and help, as well as, when rates are as high as they are, there's not many people refinancing. And we are still helping people to refinance, but it's for the people that absolutely have to because of death or divorce, or, usually it's some negative situation in their life and they're forced to do it. So with refinancing at a very low percentage of our business and people not finding anything to buy, the mortgage world is in a very different place than it was 2 years ago.
It's too bad these companies can't just say, okay, demand is low, so let's go ahead and just drop the rates on our own to kind of try to push demand upwards. It's too bad they aren't able to manipulate those rates a little bit on their own to try to offer the products to the market and let the market kind of dictate how much demand's there. It's too bad it doesn't work like that.
So Ben, super interesting comment, because when you go to buy new construction and you visit the builder site and everybody else is at 6.5 and the builder's at 4.99, the builder can manipulate their small little economy. And what they're doing is they're taking all the money that they made during the great COVID years, and if they've not, squandered it, if they've saved it appropriately, they're buying down the interest rate. They're paying the difference between 6.5 and 4.99 to stimulate their own little community or their own little economy. So they can do that actually on that scale.
Yeah, that's interesting. Well, very good stuff, Bill. I know we'll keep an eye on when's the next meeting?
So the next meeting is going to be at the end of March, and we're going to keep an eye on it as we always do to make sure that, the big thing for us is how are we watching the market and reacting appropriately in order to help our clients get the best rates and terms and plan accordingly.
Absolutely. And if you want to learn more about Cross Country Mortgage, the best place to start is a free 15-minute mortgage and loan consultation. You can get in touch with Bill and his team at 484-352-4151 or online at smartmortgageshow.com and see what all's there. But we appreciate you being a part of the channel. Hit subscribe if you haven't done that as well. We thank you for being here on the Smart Mortgage Show. And if you have questions for us, drop a comment down below as well. We'll try to do our best to answer those and maybe even feature one of your questions on a future episode. Bill, thanks for the time today.
Thank you, Ben.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.